It's a special episode of the Investor Insights series this week, as we were joined by Killik Co's very own Mick Gilligan, ahead of the publication of his new book, Investment Trusts Explained. Regular listeners of the Investor Insights series may have noticed that a high proportion of the episodes have focused on the stewards of London-listed closed-end funds, investment companies and investment trusts. And this reflects our stance that this particular fund structure presents the most ideal for generating superior long-term returns for fund investors. This new publication from Mick aims to provide a comprehensive guide to investment trusts, a circa £230 billion segment of the London-listed market. And it also details some useful tools that should help investors navigate through this sector, which contains strategies across a wide variety of asset types. In this episode, Mick and I pick out some snippets from the book for discussion. Welcome to the Investor Insights podcast, hosted by Killik Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killik Co YouTube channel, or by searching for Killik Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killik.com. Killik Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details on the unique ways in which we do that at our website, killik.com. In this episode, we were joined by Mick Gilligan, a partner and head of managed portfolio services at Killik Co. Mick joined Killik Co in 2001, having previously been an independent financial advisor, and he's responsible for the firm's managed portfolio service, a discretionary, multi-asset managed service invested in funds. Mick is clearly a very good judge of character, having hired me onto the team almost 19 years ago, and we've worked very closely together on the fund research team at Killik Co ever since. The experience Mick brings has and continues to have a notable influence on my own career, and I know many others at the firm. As a team, we provide research on a wide range of funds and also manage a range of portfolios and strategies that are predominantly invested in funds. The Investment Trust Explained book will be published very shortly and can be ordered through most of the well-known online bookshops. We provided some links in the notes section of this episode where you can click on and pre-order. Alternatively, pop into one of our Killik branches to ask for a complimentary copy, perhaps calling ahead just to ensure stocks aren't running low before you travel. If already a Killik Co client, do contact your advisor who will be happy to arrange getting you a copy. The book will also be available as an audiobook, again through all the usual providers very shortly. I hope this discussion provides a little teaser and some interesting extracts from the book to whet the appetite, but as always, please do get in contact using the podcast email address investorinsights@killik.com if you have any questions or would like further details on any of the topics discussed. Hi Mick, good afternoon. How are you doing today?
Good, thanks, Gordon. Hot, muggy day in London, but nice and air-conditioned in here.
Yeah, good stuff. So, mate, we'll go on to talk about the book, but you're not escaping that standard first question that we've asked everybody on the series. So what it attempts to do is kind of get a bit to know you, really. And we've been asking people if there's a kind of anecdote from a recent meeting or an insight from something you're doing in terms of research, or even just an article or book that you've read recently. Anything you can share?
Sure. Well, I'll talk about an article I read a couple of weeks ago. It was a piece of research that came out from Panmure Liberum, the investment bank, and it focused on the impact of share buybacks in investment trusts. Now, I think most of the content I tend to read on share buybacks with investment trusts seems to be focused on narrowing the discount, controlling something to do with the discount, which for me kind of misses the point to a large extent. This piece from Panmure Liberum was looking at the accretive impact of share buybacks. So they looked at the private equity sector, first of all, And this is a sector which has struggled to generate portfolio performance for the last 18 months. It's a difficult environment, difficult to get exits, which they need to really grow their net asset value. But it put some numbers on the extent of buybacks and the impact they've made at a NAV per share basis. So there was a couple of trusts there that enhanced their NAV by more than 5% the last 18 months, which is quite helpful in what is a difficult environment. The piece also looked at infrastructure funds in terms of the potential enhancement to income from share buybacks. So because you're taking shares out of circulation with buybacks, it just means there's more for the remaining shares to benefit from. And in this case, there were some trusts where the potential to increase dividend was as high as 10%, so quite meaningful. So I thought that was an interesting piece.
Yeah, good stuff. Yeah, we'll probably come back and talk about capital allocation, perhaps in a bit more depth in a later question. But first up, we're speaking just before the publication of the book. So what made you decide to write it?
I suppose the two main reasons. Firstly, I suppose educational. I think there are certain aspects of investment trust that are not particularly well understood, and it was an opportunity to try and explain those in hopefully what is a simple, straightforward manner. And secondly, I was very keen to redress what I see as an imbalance in terms of the amount of money in investment trusts versus the amount of money in open-ended funds. So last time I looked, the assets under management for investment trusts was around about £230 billion, whereas the equivalent for UK open-ended actively managed funds is more the order of 1.2 trillion. So it's effectively 5 times the magnitude in open-ended funds, which for me just doesn't seem right. You know, are they 5 times more superior or more suitable structure? I don't think they are. So I saw this as an opportunity to try and compare and contrast the two.
Yeah, and again, in a later question, I think we'll come on to why there are advantages with closed-end versus open-ended as well. But what I thought we'd do is maybe just go through and pick out just some elements of the book and just pick out some of the kind of highlights of that. And one of the early chapters highlights some of those interesting stories behind some of the very oldest trusts in the sector, because there's some that have been around for a very long time, and how they've kind of evolved and stayed relevant as the market's kind of modernized and changed through time. I wondered if I could ask you to maybe pick out one of those just as an example for this audience.
Sure. Why don't we talk about Scottish American Investment Company? So this was one of the very earliest investment trusts. It launched in 1873. And the background to that launch was you had a young lawyer in Scotland who had made several trips to the US in the 1860s and 70s. He was very excited about what he saw as some great investment opportunities, came back, put together a prospectus for this trust, which was oversubscribed, and then they proceeded to invest. Most of the early investments were in effectively bonds to railroad companies, lending money to railroad companies. And as time went by, it evolved, investing in government bonds, ultimately in equities. And as we move forward in time, the 1920s was clearly an interesting time for markets, to say the least. In 1928, the board of Scottish American became concerned about potential frothiness of the US market. One of the portfolio managers went to the US in late 1928 and came back to kind of just confirm what the fears had been, and they proceeded to sell down 40% of the US exposure ahead of the Wall Street crash in 29. Then if we roll right forward to closer to the current time, well, actually the 1970s. So that was a pivotal time for Scottish American because they then outsourced their investment management to an independent manager. Back in the late 19th century, there weren't really independent managers, independent fund managers in the same way we think of them today. But by the 1970s, quite a few were emerging. And the board took the view that the independent manager would be better resourced and a better place to deliver returns. So since then, Scottish American has been independently managed, currently by Baillie Gifford. One thing is quite interesting about, if you just look across the entire history of Scottish American, paying income to its shareholders has been very, very important. Since 1937, the trust has never reduced its dividend, which is quite incredible. That's 87 years of a dividend not declining. And in fact, for the last 51 years, it has increased its dividend every single year. So I think that's quite a good example to illustrate.
Yeah, one of those good examples of dividend increases. Yeah, thank you for that. So you touched on earlier about this imbalance between the amount of assets in open-ended funds versus closed-end funds or investment trusts. And the book makes quite a few very strong points about highlighting those strengths and advantages of investment trusts over other fund structures like open-ended funds. I wondered if we could run through and explore just a few of those. So, perhaps firstly, the ability for an investment trust or closed-end fund to really facilitate the ability to invest for the long term. Can you kind of explain what you mean by that?
Sure. So if we first of all just look at the difference in capital flow between investment trust and open-ended fund. So we're now kind of mid-afternoon on a Thursday. If you're an open-ended fund manager, you've had a request shortly after midday today to say how many investors want, how much people want their money back, or whether you've got excess cash coming in to invest. And you don't know what's going to happen at 12 o'clock tomorrow. You don't know whether you're going to, again, have to sell things to pay investors back, or you're going to have additional cash to invest. With an investment trust, you just don't have that issue. You've got great visibility over the amount of capital to invest, and that just lends itself much better to making long-term investment decisions. And if you think about it, if you have this potential call on capital all the time with an open-ended fund, it's very difficult to invest in illiquid assets. And quite often, illiquid assets can give you higher potential returns. And that's something that investment trusts can take advantage of that open-ended funds cannot.
Yeah, and often the issue is that the flows in and out tend to happen at the bad point in the cycle as well. So a manager's investing or having to realise assets at the wrong point in the cycle.
I agree.
And the second one was enabling kind of the flexibility of investment, things like gearing or dividends, like you've mentioned with Scottish American. Can you maybe talk through some of those as well?
Sure. So with gearing, investment trusts can borrow money to invest. Open-ended funds like unit trusts cannot. And gearing can be very, very helpful to returns over time. If I was just to put some numbers on it, if you were able to borrow 20% of additional assets at a cost of 5% a year, and I use 5% because that's the average interest rate in the UK for the last 100 years, and you're able to invest that at 9% a year, and I use that because that's the average return on the UK stock market for the last 100 years, that would generate an extra 1% a year after costs, which is a phenomenal additional boost to your returns. So that is incredibly helpful. In terms of income and the flexibility, I think investment trusts have huge advantages there. If you're an open-ended fund, you have to distribute all the income you receive in the accounting period in which you receive it. With an investment trust, you have to distribute the bulk of it, but there's an element you can retain, and importantly, you can also effectively retain profits that you've booked from sales that you've made. And what that means is that those additional bits that you've reserved can be used to supplement income in future years. And this is why you've got a cohort of investment trusts that have increased their dividend every year for quite a number of years. So there are roughly 50 that have increased their dividend for at least 10 years. And there are 10 investment trusts that have increased their dividend for more than 50 years. And that's really down to that flexibility. Scottish American's a good example. It's down to that flexibility that reserving gives you over open-ended funds.
Yeah, thanks for that. And perhaps just as a third one, perhaps most important of all, the governance piece, that kind of independent board and the oversight that they give. Can you talk us through those?
Indeed, yes. So an investment trust will have an independent board of directors, and their job is to act in your interests. And that can involve monitoring the portfolio manager, deciding whether to increase the dividend, deciding whether to take on gearing. So you've got some of those advocating on your behalf. You can vote for or against that the board of directors. You get the opportunity to vote on other important issues, and these are features that an open-ended fund like a unit trust simply does not have. They will have a board, but it's not going to advocate in the same way that an investment trust board would.
So we touched on share buybacks a little bit in terms of capital allocation, but it also comes up in various chapters as you kind of go through the book. And it's clearly very topical at the moment in relation to investment trusts of the sector. Many trusts in the sector trying to control discounts, which are notably wide in the context of history. And we're also seeing activist engagement in a number of names at the moment. Are you able to summarize some of your thoughts that you lay out in the book in relation to capital allocation?
Sure. Yeah. So with capital allocation here, we're just talking about the fact that a company, or in this case, an investment trust, has got capital, and they've got various choices about what they do with that capital. They can invest it. They can use it to buy back their own shares. They can use it to enhance their dividend. They can reduce debt with it. And there are a number of other ways they can return it to shareholders. There's no straightforward answers here. There's a lot of variables. For example, whether the trust is trading at a discount or not, whether if it has got debt, whether it's floating rate or fixed rate debt. But if I maybe just touch on the issue of whether to invest the capital or use it to buy back shares, that decision very much hinges on the level of the discount. So let's take an example of an investment trust that is sitting at a 20% discount to its asset value. For the trust to invest in a new investment, that investment has to be, first of all, it has to be more attractive than all the existing investments, but it has to be more attractive plus 20%, if you like. So buying back its own shares is akin to buying the entire portfolio 20% cheaper than you could otherwise do.
Yeah, so it's worth pointing out the book also has a number of tables and charts which kind of really drive this home, explain some of the numbers behind this, which brings it to life even more. And there's also a chapter in the book which explores some elements of investor psychology or behavioral finance. It's something that we've talked about with a few different speakers on the series, actually, this kind of behavioral finance, whether it's kind of contrarian investors or other forms. And how, I mean, the book points out how you can kind of monitor share prices and discounts and premiums relative to the net asset value, and how you could use that as a kind of guide to market sentiment. I wondered if you could maybe explain how investors might be able to build this into their own approach to kind of benefit from that.
Sure. Well, maybe first of all, I talk about one aspect of this, which I think is widely known as performance chasing. So when the net asset value of an investment trust is performing well, the discount tends to narrow, or it tends to move to a premium. When the opposite is happening, when the net asset value is performing poorly, the discount tends to widen. So that's just a reflection of, that people do tend to chase performance. I do cite a study from 2017 in the book where this is from the Journal of Portfolio Management, and we had some academics who looked at whether performance matters, whether there's any kind of patterns that they can discern. And what they did is they looked at various managers over rolling 3-year periods. They picked 3 years because that was deemed to be the typical window that a pension fund looks at before it hires or fires a manager. So they looked at how do they do over 1 3-year period, and then how did they do over the subsequent 3-year period, and was there any relationship between how well they'd done the first one versus the second. So the piece was titled "Does performance matter in manager selection?" And the conclusion that came to was yes, it does, but not in the way you would expect. So in fact, the managers that did poor in the first 3-year period tend to do better in the second 3-year period. And a lot of that could be because styles change and go in and out of fashion. But importantly, it is important for investment trusts, and it kind of lends itself to maybe not chasing performance when discounts are narrowing. I think another thing I quite like about discounts and premiums is that they provide a quantifiable way of, if you like, measuring sentiment. And sentiment's very important, but it's kind of one of these elusive things where, how overcooked are things, and discounts and premiums provide a way of measuring that. I'll just give an example of one trust that I mention in this context in the book, which is Polar Capital Technology Trust. So in December 1999, Polar Capital Technology Trust traded at a 19% premium to its asset value. Now, this is a trust that invests in quoted equity. So effectively, people were willing to pay £119 for assets that could have been bought on the market for £100. And then at the other extreme, at the depth of the financial crisis, the same trust shares traded at a 29% discount to asset value. So in other words, investors were able to buy £100 worth of assets for £71. So just being able to see those extremes and being able to look at them against the history of an investment trust in the sector, I think helps give a steer on just where we are with sentiment, how overcooked or out of favour things are.
Yeah, absolutely. Yeah. Mick, I've got a standard final question as well, and it asks the speaker to highlight one particular area of their specific investment universe, in this case, investment trust, clearly, that you have a kind of particularly high conviction in at the moment. Is there one subsector or area of the investment trust market that you're looking at the moment?
Yeah, there is. So I think to answer that thoroughly, it's important for me just to talk about how we decide on asset allocation within our portfolios. How do we decide what are the most attractive markets and the least attractive? And what we use is a series of valuation measures, which for me are the most reliable way of kind of predicting future returns. And what those valuation measures are saying at the moment is that there's two markets in the world that really stand out as pointing to very strong returns over the next 10 years. One is UK smaller companies and the other is Japanese smaller companies. Now, UK is our home market, so I won't go into that in too much detail, but Japan, I think, is worth elaborating on. And I think a lot of people just view Japan as kind of one of those value traps. Yes, it's cheap, but it's been cheap for ages. When is it ever really going to re-rate? Well, I think something interesting started to happen about 4 years ago. So the Tokyo Stock Exchange came out with a new governance code, and this was to help improve returns and improve profitability. And a number of companies have they've responded to that, but probably not to the extent maybe that the Tokyo Stock Exchange had hoped for. So 2 years ago, the exchange issued a white paper, and in that it just highlighted that more than half of the market continued to have a return on equity of around about 8%, of less than 8%. Now, just to put that in context, your typical return on equity for, let's say, the world index is about 12%, and in the US, recently it's been as high as kind of 15 to 20%. So below 8% is a pretty low return on equity, and here what we're talking about is just the return you're getting for the equity value. And also that more than half the market was trading below book value. So, half the market is available at less of its effective breakup value. And since that paper was issued, a number of companies have again responded to try and improve profitability. So just moving this on to the investment trust sector, there are a couple of investment trusts that are effectively looking to benefit from that tailwind by identifying cheap companies where they think there are good prospects for improving those returns, and they then engage with management to help them come up with solutions to help improve returns. And those trusts, I mean, they're trading around about asset value at the moment, but I think the ones I would pick up on any weakness, and for me that is probably the most interesting niche in terms of opportunities available currently.
Yeah, thanks for that. We covered some of the Japan governance and reform in a very early episode of the series. I think it was episode 9 with the manager of Nippon Active Value. So if anyone wants to listen up on some of the governance going on in Japan, like Mick just mentioned, there's that episode. But Mick, thanks so much for joining us. Really appreciate your time.
No, great. Thank you.
Thank you for listening to the Investor Insights podcast, hosted by Killik Co. You can get in contact using our podcast email address, investorinsights@killik.com, for more information on any of the topics discussed, or for further details on the services offered by Killik Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik Co is authorised and regulated by the Financial Conduct Authority, the FCA.